welcome back. We have a very, very special guest. Bill Smead joins us, who's been on CNBC, KCTS, as well as in news publications such as Reuters, Puget Sound Business Journal, a contributor for TheStreet.com and SeekingAlpha.com. I just want to get right into this. First of all, well, welcome, Bill.
Welcome. Thank you.
Yes. Thank you for welcoming me.
Yeah.
I love when people do that.
Yeah.
So, Bill, you know, a lot of people think the golden age of investing, maybe now they think it's past again as the market has now crept from 6,500, I don't know what it was today, 13,000, probably somewhere in there. And current investors are probably not behaving the same way as they were. I mean, they're kind of finicky, right?
Right.
Talk a little bit about maybe some of those characteristics of investors and their behavior as we see these pretty big swings over, you know, the course of 3 or 4 years.
Yeah, here's the way I like to think of it. First of all, we run a mutual fund. So we run the Smead Value Fund, and we're very long-term in nature. We're looking for companies that we can own for 10, 20, 30 years at a time. And I liked your monologue at the beginning because one of the things I like to do with people is to get them to stop and think, what net worth would have been required in, say, 1965 or 1970 to live the way the average American household lives right now? We all have a cell phone, and only someone with a $50 or $100 million net worth in 1965 had a phone in their car. We fly all over the place, and only the wealthiest people flew. So the truth of it is, the improvements in our life are so big that most people can't even wrap their mind around it. So they look at the current circumstances as dour, or the media convinces you that your inflation-adjusted income hasn't gone anywhere in the last 10 years, so therefore your life hasn't improved. But on the other hand, you maintain 3 times as many relationships as you used to through social media, through, you know, et cetera. So the beauty of it is, I totally agree with you. The best is yet to come by far.
There's a movie, I Am. I don't know if you've seen this movie, I Am, but it's definitely worth watching. It's from the director who actually directed Ace Ventura and The Nutty Professor, who's one of the biggest directors in Hollywood. And he just did this movie thinking about all the things that he thought, or going to interview people. Well, he had a big accident. He went out to interview all these people who thought, or where he thought he was going to find out all that was wrong with the world. What he found out was that, you know, a lot of people are better off than they thought they were, and not everything is actually measured by money.
Right. Well, it is, but productivity has been so astounding that again, people just really haven't got their mind wrapped around it. So to answer your question, here we are 3 years into one of the greatest bull markets of all times in stocks, and most people have avoided the subject. They either got killed in 2008 and just held on, so they're really happy to make a comeback, but none of them put any money in while things were super depressed, and then no one put money in when it was super depressed. So now it's like this surreal time where people are afraid to put money in because they just watched the market double in the last 3 years. And so what we try to do is we try to get them to stop and just focus on the companies involved. For example, Peter Lynch was one of the most successful investors of all time. He used to go to the mall with his wife, and he wanted to see what stores were hitting it, right, where the lines were, et cetera. Well, for example, here we are in the Seattle metropolitan area. Cabela's is about to open a Whopper at the Tulalip outlet malls up there. And of course, if you go there on Saturday and Sunday, the outlet malls, it's all Canadian license plates. So that means Cabela's is basically going to be hitting that circuit really hard. And they're opening a small store in Union Gap near Yakima. And then, of course, they have a store that's thriving down in Lacey.
South, yeah.
So the point is, that is Disneyland for hunters and fisher people and so forth, where you can go practice fly fishing. You can practice shooting a 12-gauge shotgun or whatever, and the outdoors and the boats and the whole thing. And the reality is, in this economy, people really don't understand this. If you're not buying houses as often and you're not buying cars as often, you're repairing your income statement dramatically. So the Federal Reserve keeps a statistic called household debt service ratio. And for all of you that are in the property or the mortgage world, healthy income statements lay the groundwork for healthy balance sheets later. So what's happened is Americans have substantially repaired their income statement. We now have household debt service ratio levels similar to 82 and 92 preceding 5 to 7 year prosperity periods. So the reality is, if you sell something that people want, Your business is great. We own Nordstrom. Their business is great. Nordstrom Rack is killing it. The online is
Look
killing
at
it.
Amazon. I mean,
We own Starbucks. The stock's been huge for us. We own Cabela's, etc. We own Disney. I mean, imagine what Disney's theme park business will be like when we get past this Iranian scare and the gasoline prices go back down again. Think of all the kids between 5 to 10 that live in the northern half of the United States that haven't got to go because the parents don't want to pay $4 gallon gas to drive to and from, say, Seattle to Los Angeles or Minneapolis to Florida.
it's going to be like vacation. Everybody's going to go to Wally World.
Well, that's right. And then add to that, here's the other thing people don't think about is we have, this very high unemployment level. Well, what happens 5-6 years from now when unemployment goes down to 5 or 6? That the multiplier effect of putting those people back to work is going to be huge. So you kind of put it all together. It looks like nationwide housing is kind of bottoming. We own a vacation home in Scottsdale, and I noticed in the Case-Shiller numbers this morning, Phoenix is the best performing city so far this year, and that's because it got clobbered first, so it's coming out first. And so you put it all together, and the future is incredibly bright, we think.
When you start looking at what people are buying, you talked about, selecting individual companies. That's it's what you guys do. Mm-hmm. Do you think there is overuse of people and portfolio theory and massive diversification rather than, hey, look, this is what we really think might work and you should invest in the things? Because I've had this idea that, you know what, this huge diversify all you can is really just kind of a glorified way to save money. But you're not really investing.
You're cutting risk.
Right.
They're trying to cut risk. I wrote a piece the other day. I said, it's a good thing that the wealth management community of today wasn't around when you were 5 or 6 or 7 years old. They would have talked you out of trying to ride a bike. They would have talked you out of trying to climb trees. They would have talked you out of going swimming in your favorite river near the house. I mean, all the things you did in your life that were really fun when you were a kid had some element of risk associated.
You would have had a lot of insurance.
Well, yeah. So the point you're making is if you go back to 1999, all the groundwork for this was laid when everyone in the world crammed their money into 50 large tech stocks in the dot-com boom, right? So everybody crammed their money in the tech stocks, so everything else was completely void of capital. So all of a sudden you've got gold is cheap, oil's cheap, emerging markets are cheap, international's cheap, junk bonds are cheap, all these other asset classes are cheap, and because all the money's crammed in these tech stocks. Then the tech stocks get trounced, and we spend the next 10 years moving the money away from those stocks and away from stocks, period, to all these other things. Any cab driver in America can tell you that the middle class that's growing in China is going to buy a lot of junk and that you should be on that. Well, when the cab driver and the shoe shine person can tell you, you don't want to own them. So the bottom line is this. We've just spent the last 12 years getting away from companies, and the beauty of it is the simplest things right in front of people's faces are likely to make them a lot more money. The problem is they got to have the courage and they got to have some diversification. We own 26 stocks. I think most of the academic evidence shows that once you get to 20 stocks, you get 93% of the diversification you'd get from diversifying in common stocks. So the beauty of it is, yes, we think that the wealth management community has kind of trapped everyone in a bad position because if you're doing what everybody else is doing, you're not likely to get very high returns.
Yeah, well, that makes a lot of sense. And then when you start getting people who do, I mean, people are more afraid of losing, though, than they are of gaining, right?
That's right.
And so at some level, aren't these, a lot of financial planners, they're actually giving people what they want.
Correct.
Because people are like, I just don't want to lose my money.
Well, and in the financial business, we call it career risk. They don't want to lose the customer, right? If you call a customer and say, I know you've got this mutual fund that has a lot of gold holdings, and I know that gives you a lot of comfort because you're seeing ads with Pat Boone in them or G. Gordon Liddy, right?
Bring in your gold, baby.
How many people? Is it really good advice to get your investment advice from a convicted felon like G. Gordon Liddy? But anyway, forgetting that for the moment. So the bottom line is that people are investing motivated primarily by fear. And therefore, scarcity adds value. So if you want to add value, what is scarce is thinking about wealth creation rather than fear of loss. Think wealth creation. And that's true if you're in the real estate world. It's true. Warren Buffett's the most successful investor of all time. He just wrote his annual letter. he basically trashed on bond investments because the inflation is and the taxes are going to eat up the return, and you're not going to have any purchasing power. He trashed on gold. He actually compared it to tulip mania, which is the worst bubble.
Sure, in Holland.
Yeah, exactly. And then he said, so really the only opportunity right now is to own businesses / common stocks, same kind of category. And then he said farmland and real estate. He said if he was a young man and was any good at fixing houses, he'd buy a bunch of houses and fix them up and rent them.
If it was rational, he'd buy as many single family homes as possible.
He said if he could, he'd buy 1 million homes, right?
I think he actually could afford it.
Yeah.
It's just,
he could afford it.
Yeah.
So he said that. Now we took a look at farmland, and farmland is actually way overpriced because we can look back 205 years and see that commodities are the most overpriced almost for any 10-year stretch looking back 205 years. So you put this all together. Here's kind of what it all boils down to for us. We look and say we've got a relatively anemic economic recovery, partially because housing's been slow to come back because we had a big bubble that got crushed. And then commodity prices are very high, which is very unusual coming out of a deep recession. The primary reason is because China's been booming and the emerging world's been booming. Well, it looks like if you're reading the paper the last 3 to 6 months, China's slowing down. China slows down, commodities come off, housing comes back, household debt service is in pretty good shape, banks are in good shape, the finances of companies are in good shape. All of a sudden, you got a lot of really favorable ingredients for us to maybe have a 5 to 10 year prosperity period coming off this. And not the doomsday guys, they're not saying that.
Well, it's because the doomsday guys are on TV a lot, and but it's fair to say that people, I think you're 100% right in that investors are scared, and maybe they shouldn't be, because they should be thinking about, nobody thinks I don't want to be poor, not in this country. Everybody wants to be rich. And everybody is just one day from being rich. I mean, that's the way Americans are taught to think, right?
Right.
Tomorrow I'm going to have the private jet. But people don't actually, their actions, I think their actions don't say that.
See, we run a mutual fund. Our turnover the last 3 years has averaged about 15%, which if you do that for 7 years, it means you held the average stock you owned for 7 years. Well, the average holding period in the New York Stock Exchange is about 10 months. So no one owns companies anymore. They rent them. And by renting them, they're completely susceptible to market swings. In other words, people call me up today and say, "Gosh, Bill, your funds run up a lot so far this year. Should I invest?" And I say, "Well, look, if you have a 5 to 10 year time frame, the answer is yes. If you have a 3 to 6 month time frame, I have no idea. It's a crapshoot. So the reality is, think of the Michael Phelps, the swimmer. He happened to have a perfect body for swimming, but if he hadn't spent the 4 to 8 hours in the pool for 15 years, he wouldn't have won all those gold medals. And see, with investing, you need to spend the 10 to 15 years in the pool with the companies you're going to own if you want to get the gold medals. And you're right. See, wealth can be created in time frames that are appropriate. And most humans, because we're all going to die, want to compact and shorten the duration of all their investments. And the truth of it is, this is a great time to expand those durations because most humans don't want to do it.
Well, Bill, I appreciate the get rich slow anecdote, because I think that really is where people do need to be. And I do also believe, I do agree with you also, that the investments that people should be making are not always the safest, but they're the best. I mean, there are investments that you can, like as you said, you can watch these things grow. They are, it makes a lot of sense. So, Bill, thanks so much for joining us. Again, that is Bill Smead, CEO and CIO of Smead Capital Management. When we come back, it isn't all about money. A lot of times there are foundations and missions for people that can raise a lot of money to help save lives, and that is probably, and guaranteed, not even probably, that is more important than just the money people can make. When we come back, we're going to talk about Brandon's Goal Foundation that has been raising money for kids' cancer research for years. My name is Ben Brashman. We'll be right back.